Gold prices are at all-time highs. Now that alone gets attention, but the price itself isn't the most important part. What matters is why gold is behaving the way it is behaving, what it signals about currencies, and especially the dollar, and really how investors are positioning themselves with exposure. Now, this video isn't about calling the tops or the bottoms, it's about understanding the forces driving gold and how investors are accessing the theme from different angles. See, when gold reaches all-time highs, it's rarely about short-term speculation. Gold is a monetary asset, not necessarily a growth asset. So it really reflects confidence, or rather lack of confidence, in the financial system. And sustained strength in gold typically signals long-term currency debasement concerns, sovereign balance sheet stress, demand for assets outside the traditional fiat financial system, and again, not having trust in the system. See, this isn't a retail-driven behavior, this is a capital allocation behavior. And gold doesn't need the excitement to move, what it really needs is structural demand, and that comes from central banks, sovereign wealth funds, and massive institutions. So what does this really mean for the dollar? Well, gold and the dollar aren't enemies, they're just simply alternatives. When gold strengthens persistently, it often reflects declining confidence in the fiat purchasing power over time, which we all know the dollar has basically collapsed since it was first created. But what's notable is that in the current environment, gold isn't just strengthened in one region. It's actually happening everywhere right now. And central banks, sovereign entities, and even China has started to really expand its gold operations, both on the production side and in accumulating more and more. See, central banks and sovereign entities have been steadily reducing their exposure to T-bills and increasing exposure to physical hard assets. So this isn't a trade, this is a reserve-based decision. People are calling it the debasement trades, but I think this distinction really matters. See, hard assets are becoming more and more important. Paper synthetic assets are always levered up, or they're always lent out to receive a yield. Gold also has other programs that can help you produce yield, but the point that I'm trying to make is if you own the physical asset, you are in a better position 9 times out of 10 because you actually own the custody of the asset. And see, countries right now are reassessing their reserve compositions based off of who has custody in the physical asset, not just the paper. And that's obviously how our dollar started, right? We had a dollar that was backed by gold. And then we say, hey, nothing to see here. We're going to get rid of the gold here and you guys just use this paper. So really, physical assets are becoming more and more important to investors, especially institutions and central banks. Now, one way to get exposure is by actually holding the gold yourself. You can have actual gold coins or gold bars. Now, obviously, it's not that common for people to carry around that kind of stuff. So it is just more of a concept of having something physical so that way you can transact if we ever go Mad Max. The second way, though, that people get exposure is typically through equities, and they can do so through ETFs, or they can do so through gold mining companies. Now, mining companies actually introduce operating leverage and cash flows and the gold price. So it's an interesting way, for companies to be valued. I was actually just at an event in Switzerland with junior miners, senior miners, large-scale producers, and the way that these institutions value these companies is very interesting, but more on that in another video. What I can tell you, though, is there's a lot of speculation around this sector. Just be sure you do your own due diligence on the ones that are, in the very beginning stages. The ones that are closer to production are typically a lot better and a lot less risky. But the ones that are in the very, very early stages, just know that needs a lot of private capital and there's not a lot of production there. But overall, there are still a lot of things that are undervalued and underpriced in the junior miner sector. So what I would really do if you are interested in investing into gold mining stocks is watch the institutional flow. See, they don't get a lot of headlines, but there are massive institutions like Van Eck and like Franklin Templeton that actually invest a lot into gold mining companies and companies that are along something called the Lassonde curve, which you guys will probably discover more throughout, researching gold mining stocks. But you'll find more and more companies through that process start to receive institutional capital, and those are safer bets than just some random mine that you find online. Now, the fourth way that people actually start to cash flow from gold is by taking advantage of the volatility. And see, that's exactly what I've been doing along with some of my mining stocks and my equity positions. I've been actively running trading algorithms that have exposure to gold, And that's what me and my clients are doing. Now, it's not directional speculation. It's more about structured participation in the volatility and in the flow. So if you want to learn more about that and how that works, there's going to be a link in the description. You can watch the video that breaks it all down. You can book a time with me or my team. We can kind of go over, see if it makes sense. But overall, you can take advantage of gold in so many different ways, whether it's the physical asset, whether it's a paper version of the asset, whether it's the volatility. I mean, the possibilities are endless right now, but it really is getting a lot of flows from institutions and central banks right now. So it's a good time to start looking at your allocations. But here's why I think this matters going forward. See, gold, if you didn't know, has been suppressed for a long time from central banks and from massive institutions. So the fact that it was able to break through some of the spoofing levels that it had prior goes to show you that this market is fundamentally broken and people are requiring the physical asset itself. No longer can they play paper games and, put certain constraints on everything. People are wanting the physical asset. Central banks are wanting to reserve their wealth in this asset, and it's only going to continue to go up more and more. In fact, last I checked, it was at $4,610. I'm sure when you're watching this video, it's probably going to be higher. And so really that should be a signal to you and your family that there's activity going on here, and that big of a move from about $2,700 to $4,600 in about 2 years is a massive change in how our money works. It's a massive change in attitudes towards currency, reserves, and risks, and it reflects capital looking for durability over the long term. So whether you're going to go through direct ownership, mining exposure, or algorithmic trading strategies to help the cash flow through it, gold is reestablishing itself as the core monetary asset. And that shift tends to happen quietly, and then it becomes extremely obvious, which if it isn't obvious by now, I don't know if you've been sleeping under a rock or what, but this is happening and it's happening fast. So if you like this video, go ahead and like, share it with a friend of yours, and subscribe, and I'll see you in the next video.